Monetary Policy Committee meeting, in fact, kicked off yesterday and usually kicks off on a Wednesday. We know that there's lots to talk about and a lot that they need to consider, especially this time round, because we've got better than expected retail sales numbers for the month of May. We know that manufacturing is still under pressure, unemployment is also an issue, and then you've got wage negotiations, which are becoming even more aggressive, which is going to impact inflation down the line. So I would say a pretty tough decision. What is Standard Bank expecting, given the fact that most are changing their view, saying that we could see between 25 basis points and 50 basis point cut?
Morning, Eleni. Yes, undoubtedly it's a very tight call. If we look at what the market's kind of assigning in terms of probabilities, we've seen the FRA curve assigning around a 50% probability of an interest rate cut of 50 basis points at this meeting, and then if they don't cut now, they're saying that there'll basically be an 80% chance of such a cut materializing over the next kind of 6 months. So the market is leaning towards more monetary accommodation. The timing is kind of up for debate. Here at Standard Bank, we still maintain as a base case scenario that interest rates have bottomed at current levels. But I think there's undoubtedly growing risk of another interest rate cut. And I think we've seen a lot of suggestions by the authorities talking more about growth, talking about reserve accumulation. And we know that another interest rate cut will help reduce the sterilization costs of building up those reserves. So I think if you had to cut interest rates, it would certainly help the man in the street with high debt levels. It will help the businessman in terms of his cost of capital, and will also help the Reserve Bank to buy those dollars at cheaper rates. So it reduces that opportunity cost. On the other hand, as you mentioned, all those risks to inflation, i.e. the wage negotiations, the electricity prices, the World Cup effect, and of course, if we are indeed correct here at Standard Bank and the rand does weaken in the wake of an interest rate cut and for other reasons in the latter half of this year, we could also see some inflationary pressures coming through in the form of high petrol prices or any other component in the CPI basket that is kind of vulnerable to higher international prices. So I think it is a very tight call. At the moment, we're still holding for an unchanged decision, but I think the risks as assigned by the FRA curve are pretty accurate. I think it is a 50-50 call, but if you look further down the line, there is that chance that they could actually cut.
Where does that leave the rand, Michael? Because, looking at the OECD warning South Africa about a very strong rand, you've got fantastic flows coming into the country on a year-to-date basis. Apart from that, massive resilience coming from the rand, despite the fact that the South African Reserve Bank has accumulated quite a lot of US dollars as well. Your view on the rand at this point in time?
Yeah, it's very interesting to see how it will pan out, because in the past we've seen the rand strengthening in the wake of interest rate cuts, but that was at the time when risk appetite was very high, people were buying South African equities, and we saw those strong portfolio inflows. Now we're seeing the risk appetite globally becoming a lot more tentative, so I'm not convinced that another interest rate cut will spur a huge demand for South African equities. We could also see the bonds taking a little bit of a bath if they had to cut interest rates, because obviously the yield pickup that foreigners are earning will be eroded. So I think that on balance the rand will probably weaken in the event of an interest rate cut, which has not been the case, and I want to drum this point home. This has not been the case over the past 12 months, but I think the tide is turning because of this global risk appetite now becoming a lot more tentative, and we've seen that people are focused on whether or not this recovery globally is in fact still on track. Countries like the US, China slowing down, and of course we know Europe's got its problems.
Very quickly, Michael, looking at the Fed, very quickly.
The Fed, we've got Fed Bernanke speaking today. He's going to deliver his testimony on the state of the US economy to the US Senate. Based on the FOMC minutes we saw last week, we expect him to paint a pretty gloomy picture, and that will also be bad for the rand, because the rand and other risky assets want to see the Fed governor talking an upbeat story and the global recovery being on track, but I don't think that's the case. So we think that importers should be covering for it now. We think the rand's going to weaken for international factors and because of this MPC.